heard a bit of different topics this morning, right? We started with the sexy pieces, the tech and what we can do in the future. And then we spoke a bit now about financial sustainability. And I think it is very important, right? Because how can we talk about all the investment needed to do the great stuff to succeed tomorrow if our house is not in order? And I think what I'm going to talk about is also a bit in that context. Because in the end, reinsurance is for most insurance companies one of the biggest expense items, right? So knowing and understanding that market, knowing what drives it, knowing what to expect is very important for proper budgeting. If you expect that I give you the outlook in terms of property cat in Indonesia will go up by 20% at the next renewal or attachment points go up, I think I'm going to disappoint you, right? I don't have that crystal ball. I guess if I would have it, I would perhaps work as an asset manager somewhere and enjoy billions of returns and not be here today. So it's a more modest presentation. As said, I want to talk a little bit about the drivers of the market and how the different players in the ecosystems are also interlinked. Because I think that's also very important. You need to understand the global markets, reinsurance, and how that's linked also to local, to be able to connect these drivers with what will maybe happen at the next renewal in Indonesia. So let me start with that. The big global reinsurers' main purpose on the P&C side, and a lot of the things I say is simplified, right? I can't give the insights into everything, but a key role that we play is managing cat risks. Right? If you are a primary insurance company in a certain market, whether it's Indonesia or any other market, usually it's okay to look maybe at 10 years of experience on your non-life side, and if that's good and you have done your analysis and you have adequate reinsurance protection, you know what you do, right? A global reinsurer, though, in the end, absorbs all these shocks, right? The large cats that maybe only happen every 20, every 30 years. So we have to focus a lot around assessing this the right way, making sure that we also survive despite absorbing all of this. The situation is actually very similar for the smaller international reinsurer and the local or regional reinsurers compared to the primary market. Because differently to the large international reinsurers, those smaller players, they often also offload significant part of the risk to the global markets. I think that's the main point I want to make here. We need to understand and acknowledge the different roles that we play and how they are interlinked, right? Because we still often hear that, why is my price going up in my market? My performance was good, right? But if you understand that linkage to the global markets, it becomes much easier to understand. Because the reinsurer thinks globally and not just for one individual country. So what I want to do next now is look at the last decade or a little more in a very simplistic way what has happened to the global industry and look at 2-3 key factors, and I hope that helps you a bit to make your own informed decision on what to expect. I think the 2010s in my simple model, you can kind of distinguish in 2 phases, and if you add the last 3, 4, 5 years, that's the third phase that I want to talk about. If you think back 2010 to 2015, after the great financial crisis, something quite unique happened, right? The world entered slowly into this phase of quantitative easing. Zero interest rate is the word. I think that's something unheard of, right? And we have rarely experienced. At the same time, the net cat markets globally were very good. There wasn't much cat activity, there weren't many losses. So, interesting market, right? High return on equity, capital costs are low, no losses, I go all in. And this is what happened. There was a slowly and steady inflow of capital in that period and very good returns. Though, in the middle of the last decade, it started to change. The net cat activity picked up more and more, but at the same time capital was still cheap and was still coming in. So the reinsurers' returns started to go down a lot. There was a lot of pressure building up. Though the pressure wasn't big enough to change anything. I remember there were many renewals where we were also thinking, when is it change, right? It becomes very tough. But I guess the big driver was that easily available money in the global system, right? So despite loss activity picking up, there was still a lot of capital looking for a return. And sometimes a simple diversification argument was enough to invest into reinsurance despite the returns being very low. But the story continues, right? And if we look at what I call the trigger years, right, 2020 onwards, you know the story, right? The pressures just became too big. We had COVID, we had really what we call unprecedented cat losses, right? Every one of us who reads newspapers, I'm not telling anything new here, I think has heard that word unprecedented maybe 100 times the last years, right? The biggest rain in the last 100 years, the biggest flood in the last 50 years. And we know, right, there's an underlying climate change trend we all still struggle to quantify, but we're all starting to realize it's something we can't ignore and it's changing the world. And the other big driver what changed is, due to COVID and the big impact on global economies, the quantitative easing stopped, right? We entered a period of inflation, and to address that, central banks around the world have significantly raised interest rates. And money as a result is much harder to come by, right? If you sit somewhere and you want to create your new reinsurance startup, I think still today, while things have improved, you get a lot of questions compared to 5 years ago. It's tougher. And then I guess this is nothing I have to really spend a lot of time about. You know it, right? The last renewal, especially the last 12, 18 months, have seen drastic changes. Whether it's pricing on the retro side, whether it's pricing on global cat, or whether it's even on the large global direct facultative, significant increases. It wasn't only the pricing though that changed. There's also big structural shifts, especially in the large cat markets in terms of attachment points. We see it in our markets too, but a bit less. And this maybe comes back, we will talk later a bit more about it, to those increasing cat trends, right? The reinsurers also realize these increasing smaller losses and bigger losses we need to share differently. It's hard if only the global reinsurance absorbs them, and that's where this push is coming from. So the one thing that is clear, right, and it's not the nicest message, for all the insurers in the room, the world is a tougher place these days, right? It might have improved for me as a reinsurer to some extent, and we talk about that in a while as well. But definitely with the increased attachment point and the higher cost that you have, your balance sheets are much more vulnerable. I don't have the answer to solve this, right? And I will not really talk about that today. Maybe a few comments I want to make. And it might be even related to the first presentation today. Data, right? And also to the second. And the discipline of how we underwrite and manage risk will become even more important to be successful in that environment. But let's dig a bit deeper, right? It's not just storytelling. There's really data that really very nicely in a simple way shows what happened. So if you look at the top left, there's something I stole from a Hannover presentation. You see, it's maybe a bit small, but you see like from the late 2000s to kind of 2021, how return on equity, that's the bright line, has kind of reduced slightly and how it was moving. And the light gray line shows the global cat pricing based on the index from Guy Carpenter. So it's very clear, right, how the performance of the global reinsurance industry is linked to the cat pricing. And with the dynamics I've explained before, it was eroding over a long period of time. And it's also, there's this dark blue line that kind of represents a proxy for cost of capital. You see the actual returns from like 2016 onwards don't look good anymore, right? This kind of just shows with data what I described already. And you also see the demand and supply, how it has changed, right? If you look at the bottom right, chart from Gallagher, you see nicely how the capital 2015 onwards was still increasing, despite the returns already not being good, right? But money was still cheap, until it kind of flipped, right? And now we are in a world where capital is a bit less available. I think there's some good news. There's different numbers around, like the Gallagher number actually says that this year it went up by 13%. Our own numbers shows a much smaller increase. I don't know exactly, there are different definitions, right? But we do see this year that capital is slowly coming back. But not yet to a stage that it dramatically moves the markets. That's also very important to note. I want to talk now a bit more about this cat piece, right? Because that is very important and to understand. If you look at this slide, you see on the right this light green line. This is like a Swiss Re cat price index that we published for many, many years. And there are a few things to note, right? While we do see the spike from the hardening market on the right side, if you really look over a longer period, it's actually not at its all-time high. Despite the losses, and I maybe go one slide back to quickly show that right chart, despite the losses, still having a quite interesting upwards trend. So why I'm saying that, of course, from a reinsurer's perspective, we hear a lot now, your business is very good, your results this year are very good, right? When can I as an insurer participate? And again, we also don't know what the future will hold, but if we look at this picture, it's maybe a bit more balanced, right? I think we are all still searching for what's the right level, right? The loss trends, they will not go away. And this is what worries us as a reinsurer a lot, right? Climate change is one of our biggest worry. And what we have seen especially is what we call that secondary perils element. If you go a few years back, most losses that we see were the big storms, for example, right? And the loss from a storm was really from the wind. But what we see more and more these days is not the storm that creates the biggest loss, it's the rain that comes with it. That's one of these secondary perils, as we call it. Or it's the wildfires that we see in Australia or in California that we see more and more of, and that the whole industry, including us, is still investing a lot in and trying to understand better and model better. So with all this and the trends that we see, question mark, right? We can discuss it later what you think. Is cat pricing really globally now at an all-time high? Or are we playing catch-up, right? I don't have the answer either. Why the secondary primary perils topic is also important, that's maybe where I want to conclude that cat topic, has to do with the structure. Right, I mentioned it before, we have not only seen price movements that were very drastic, but we also see reinsurers forcing insurers to retain much more of the losses. And one piece there is this increase in the small frequency secondary perils losses. That is with that role that global reinsurers play, the shock absorber for the large cats, not really in line anymore. And this is where this pressure is coming from. The global reinsurance industry wants to impose a bit more of that risk to the insurance industry because we believe that's needed, that it's managed better in the future, that there's more attention closer to the source of the risk. And this piece, I think, will likely not go away very soon. Fast forward, right? Our world is so volatile. Maybe some of you might think, is that the latest? Right? We saw a lot of new problems emerging just on the last weekend. But some of the themes, I think, are still quite relevant. If we look at the outlook of the economy, we do have growth still, right? But we see some cyclical slowdown overall. China has slowed down. They have the housing crisis. The reopening effect is fading off slightly, but it still has solid growth, right? The Western world is close to recession. Some areas are, some are not. Expected to slightly improve, but also not a lot of growth. Inflation, right? The other key topic that we discussed last year, and is still a very relevant topic, will also stay. I think inflation has two dimensions. I will not talk about the first and maybe the second a bit later. The first one has to do with the rate setting policies, right? And while the Fed itself says they might not be done yet with further hikes, they might be almost there. There is a big group of economists that maybe actually think they are done. So there's some debate, will they hike further, will they not hike further? But where there is a very big consensus, reductions on a significant level, they will not come very soon, right? The inflation is stabilizing, it's improving, but we are not yet at levels that we can expect in the next 12 months drastic cuts of rates. So that elevated environment will stay. And in my view, that will also continue to investment cases to bring in new capital being maybe more scrutinized than 6 years ago. That will stay. There's also a good effect, right? These rising rates, global reinsurers are also large investors. So our asset returns will go up, right? So that will help. That's the good thing of it. So there are two factors there to bear in mind. The outlook though is not an easy one, right? Can talk maybe about it later. I don't know. The world is a complex one. But all this uncertainty, and that's clear, will also lead to the fact, together with the climate change uncertainty, that we are still in a cautious investor sentiment environment. But I personally do not believe that people will become super bullish very, very soon. As long as the world is so fragile, as long as results of reinsurance, they have improved, I mentioned it. But only for 6 months, right? As long as we can't prove for maybe 12, 24 months to investors that we make consistently money, there will not be lots of capital coming in. It will slowly come in. There's always cycles, right? But it will not be drastic. And I maybe skip here a few things so that we have also some time left for the discussion later. And just conclude with these 3 points, right? The cat losses, they stay. We all don't know how to quantify them, but they will stay and they will continue to be a concern for reinsurer and will make us very sensitive to discussions on reduction of that. The economic situation remains volatile, what leads to still a cautious investor sentiment. And last but not least, with all of that combined, I think we need to be prepared that it stays a little bit uncertain, right? We have signs now, better results for reinsurers, better asset returns expected. Yay, maybe investors get more bold. But on the other hand, we don't know how those trends play out, we don't know how the world play out. So until we really reach an equilibrium, it will take time. But what I really do believe, and that's maybe the good message I want to end with, for global renewals and also Indonesia renewals on the non-life side, we at least expect something much more orderly than last year's, right? We don't think there will be another round of plus 50% increases somewhere. Of course, it always depends, right, on how loss affected and what idiosyncratic problem an individual company has. But overall, we should have a much more orderly renewal. A lot of the work has been done, but it's still not the easiest time.